Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 10th. Hey, how you doing? I hope you're having a nice weekend. I appreciate you coming to my weekend review podcast. And market kind of interesting. We haven't really moved in the last 4 or 5 days. We've gone up a little, we've gone down a little, we've gone up a little, but overall, it's been pretty flat. Actually, for me, it was a bit of a challenging trading week. I had some setups this week that I felt really optimistic about, but they didn't come through. And it's just a good learning lesson that no matter how good the setups are, um, they can fail. And I had some of those fail for me this week, and I'll certainly share those with you. But keep in mind, no matter how good your setup is, they can fail. And so we have to position size correctly. We have to follow our rules correctly because you just never know. All right. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences of entry signals were, and big picture levels. We're going to talk about how I position size correctly, how I am going to place my emergency stop, how I'm going to place my end of day stop, how I'm going to take partial profits if the market moves in my direction by a certain amount each day. And then we're going to talk about significant overhead resistance levels of where I am going to completely exit the trade. All right, so we'll talk about when I entered, why I entered, and most importantly, how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. It's the most important skill in trading. It's not chart reading. It is being able to come up with a plan and then to follow your plan no matter what, whether it goes your way or it goes against you. It doesn't matter. If you're trading correctly, if you're position sizing correctly, you're getting into your trades, one trade doesn't matter. It can be such a good setup and it can fail, just like I mentioned a moment ago. How we have to look at trading is each trade is just one trade of the next 1,000 trades. It's like a hotel. I'm sorry, like a casino. They have blackjack, they have baccarat, they have 21, they are craps, they have roulette. Every roll of the dice, every spin of the roulette ball, that casino doesn't care from one bet to another whether they win because they know over the long run they have a mathematical edge. If you're trading correctly with the right confluences, good risk to reward ratios, over time you should not care either because you have an edge. But from one trade to a next, yes, you can lose, just like a casino loses a roll of the dice or a spin of the ball or a dealing of the card. One particular game to the next, it doesn't matter. In the long run, that's what matters. So that's why it's so important to get yourself a good trading process. Doesn't have to be fancy, doesn't have to be complicated. But when you decide on that process, you need to follow it. And that comes down to trader psychology. So I always like to talk about it. It helps me to teach it, and hopefully it is helpful for you to hear it. After that, I have gone down through my watch list. Every Friday night, I go down through my master watch list, and I look for the next week for some potential markets to get to certain areas. Now, they're not there yet because if they were there already, I probably would have already taken a trade. But I look for, in the future, I look and say, okay, Apple, for example. If it comes down here, then it's going to have this, that, and the other at the same time. They'll have a confluence of maybe order blocks, maybe 200-day moving average, maybe 30 RSI, maybe bullish MACD divergence, right? It's going to vary every single week, but I can look at a chart and go, oh yeah, if I had my choice, I would buy it there. Well, you can do this. You can wait until a particular market gets to the level that you want. It's called patience. But if it does get to that level, that's a good time to take action and potentially take the trade. If and only if it gets there. If it doesn't get there, fine. Just leave it alone, get on to another market. So that's what I like to do on the weekends. I like to go through the entire list and look for some potential trades for next week that are not there yet, but if they get there, they say that would be really a good trade because of this, that, and the other. So that's what I'm going to share with you. I hope that's going to be helpful. I hope everything's going to be helpful today. And if it is, I really would appreciate it if you could hit the thumbs up button. It really helps out the channel. It lets YouTube know that there's some valuable content here, and so they can share it with more people. And if you haven't subscribed, I'd appreciate it if you could subscribe as well. Okay, so let's get this U.S. legal disclaimer out of the way, and then we'll get rolling. So hang tight for about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's go through the current position. So let's start off with QQQ. This is a trade that I took all the way back here on the 8th of April, right near the bottom. This has been a really good trade, and it shows the power of order blocks and confluences of signals. Let me zoom out a little bit first and give you an idea of this green block here. This is what I keyed the trade off of, and this trade that I took here on the 8th of April, the reason I took this goes all the way back to a year ago, almost a year ago, to 4/19/24. So I based this trade on something that happened a year ago. So what's that all about? Well, this green block here is called an order block. And an order block is your lowest low close before a market structure change. And for a bullish market structure change to happen, you need a swing low, you need a swing high, you need a swing low, and then that first swing high needs to be taken out, or the price needs to go up through. Now this makes this an order block even out into the future, even a year out into the future. Now they don't always work, obviously, but they sure work a lot more than they don't. And you know, it's really interesting on the Qs here. Again, here's the order block. It's your lowest bar close before market structure change. We change market structure here, and then we go zooming all the way up here. Well, you know, I like to kind of put it into these terms. Here at this very top, if you look back to that order block, I think it's safe to say that the smart money was buying here. Wouldn't you say? Right? In hindsight, it's very clear that smart money was buying here. So one of the ideas here is that if smart money was buying here, if the price comes down to this again, will that be a smart money area to buy again? And a lot of times, yes. Sometimes no. You know, things change, politics change, economies and world economies change. But I want to point out right here, look at this, August of 2024. We have the order block, we change market structure, we come down almost to the penny, to the top of that order block again, and then we rally off again. All right, so going into the future, we were not even close to this particular order block, but when we had the big sell-off in April, we actually got down to the order block. And the way that I trade order blocks is if I have a rejection of the high of the order block, that's a potential entry. If I have a major moving average, deep dip buy moving average like a 200, 300, 250 inside the order block, that's a really good setup. Or if we reject the bottom of the order block, that is also a setup. So on this particular trade, you can see I entered here on the 8th of April because on that particular day, during the day, we went below the order block, yet we recovered at the end of the day and closed in the order block. Well, that was the signal. So I love order blocks. I use them every single day in my day trading, and you should look into these things. There's information out there on the internet about it. I teach a 15-hour private one-on-one course to traders all over the world. And I'd like to have you as a student, be very happy to have you as a student. I'm teaching 4 students right now, if you can imagine. But we certainly spend hours and hours on order blocks. So if you're interested, please send me an email and we can do this 15-hour course together. It's one-on-one. I think it's the best way to learn anything is one-on-one with your teacher or instructor. So I got long here, the Qs at 416.22. Now, as soon as I decide to enter a trade, really the most important thing, in my opinion, in trading, the most important thing is how many shares are you going to buy, right? If you're going long. And I like to use this formula because, one, it's conservative formula based upon your account value size, and it also takes into account volatility, which is extremely important. So I have 2 inputs into this. The first is how much do I have in my trading account. The second is what is the 2 average true range, or in other words, the average true range times 2. Okay, the 2 average true range. So let's say, for example, I had a $100,000 trading account. It's very simple. 1% of my trading account, 1% of 100,000 is 1,000. If you had 50,000, that's 500, right? Million, it's 10,000. So I take 1% of my total trading capital. Let's say it's total trading account. Let's say it's $100,000. 1% is $1,000. I then divide that by the average true range of 2, which is 2180, and that tells me to buy 45.87 shares. So I'll just round it up to 46 shares, right? If you had a $200,000 trading account, it would be 2,000 divided by this. It would be, you'd have double the shares. You'd have 90 shares or 91 shares. So this is a really good formula to use no matter how little or how much you have in trading account. It takes into account that in the worst case scenario, you're going to lose 1% on this particular trade if you're wrong. But to the upside, you have a lot more that you can make to the upside. And that's what it's about trading, is having good risk to reward ratios, having the opportunity to make more than you're able to lose. So the rejection of the order block here got long 41.16. The amount of shares I bought is $46 based upon 1% divided by the average true range times 2. So I enter here at 416.26. Now, the very first thing I do after I enter is I need to go back to my 2 average true range, 2180, and I need to take my entry price minus 2180. And I put this red line down here. That is my emergency stop. My emergency stop is kind of the worst case scenario. And let's do the math. If I have 46 shares and it goes down 2180, how much have I lost? I've lost $1,000. I've lost that maximum allowed loss on the trade. Now, the good news is that this maximum allowed loss, this emergency stop, only happens about 5% of the time. 95% of the time, if you take a loss on a trade, the way that I set this up, 95% of the time, if you take a loss, it's going to be a much smaller loss than that 1%. Remember, 1% is the maximum, right? So I have 2 stops. I had to take my entry price minus the 2 ATR. That's down here. If it gets down there, that's a 1% loss. The end of bar stop is if I close below my end of bar stop. Well, my end of bar stop on this particular trade is a close below the order block, right? Just to close below the green box. And so if the next day it had closed below the green box, I'm simply out of the trade. So the 1% maximal allowed loss emergency stop is down here, but that only happens about 5% of the time. The other 95% of the time, if I have a loss, it's just going to be a close on this particular trade below the order block. So I have a very good risk to reward ratio. The price is very close to my stop anyway. So, instead of losing $1,000, maybe I lose $120. That's fine. That's just the cost of doing business. Okay, so rejection of the bottom of the order block, place position size correctly, place the emergency stop 2 ATRs below. I know my end of bar stop is a close below the low of the order block. The next thing I do is I take my entry price and I add to it the value of the 1.5 ATR. Right now, the 1.5 ATR is $16.35. So I take my entry price, add $16.35 to it, and I always place this orange line. What is that? That is a trailing stop level. So what all that means is if in the future, if I move up 1.5 ATRs from my entry, now I go into what is called trailing stop mode. So in a way, I'm just starting to tighten up my stop because it's moved my direction. And all it means when you get to trailing stop mode is that now in the future, if you have a close below a previous bar's low, you're going to get out of half the position, or I'm going to get out of half the position, which happened here, but I'll go through exactly. But just want to kind of show you that. So everything I've talked about so far, the position sizing, the emergency stop, the end of bar stop, the trailing stop mode, these are all defensive maneuvers. Or in other words, if something goes against me in the direction I don't want to happen, I need to take action. But I also play offense in my trading, and I play offense in my trading by taking partial profits each day if it moves a certain amount of distance from the close of the previous day. So I am currently in this position in the QQQ, and I always look at the closing price. So it's 487.97 is the closing price. This is for Monday, but I do this every day. 487.97. Then I look over here. What is the value of the 0.45 ATR? And it's 490. So I take my first profit target, 487.97 plus 4.9. My first profit target for the day is 492.87. So right about here is my first profit target for Monday. Then I do it one more time. I take the first profit target, 492.87 plus 4.9. My second profit target for the day is 497.77. So that's going to be right about here. And then I do it one more time, 497.77 plus 4.9. My third profit target for the day is going to be 502.67. It's going to be equidistance here. So I have 3 profit targets every day. Now, if I hit a profit target, I place 3 limit orders. How much do I take off? It's very simple. I just take off 10% of the amount of shares that I went into the day with. If I went into the day with 50 shares, I would take off 5 here, 5 here, and 5 here. And I do this every single day. If the market's up, maybe I hit 1 profit target, maybe I hit 2. If the market's down, I hit 0, but then I just redo it every single day. And taking off partial profits into strength, it for me, I think is a key to one of the keys to my trading success is giving the market a little when it wants to pay you more for it. And I do this on a day-to-day basis. And what's nice about it is if it does move up and you take some profits, and then for some reason if it moves back down against you strongly, well, at least you took some profits off before that happened. Because once you take those profits off, the market can't take that away from you. You've reduced your position size, and if the market goes down from there, you've mitigated your loss. Okay. All right. So let's take a bigger look here, just kind of starting from the beginning, and we'll see how this played out. Okay. So I entered the trade. Why? Because of an intraday rejection of a long-term order block. I entered at 416.26. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. My trailing stop level is here. The very next day, huge upward move. I didn't just hit 3 profit targets on this day. I think I hit 6. I only placed 3, but if I hit my third, then I can place more. So a huge day up immediately after I entered. Obviously, we got to trailing stop mode. Now I'm in trailing stop mode. So big, huge day up. Next day down, no profit targets. Next day up, 1 profit target. Next day up at the open, profit target. Now remember, I'm in trailing stop mode because I got to trailing stop level. Here is the first close below a previous bar's low after reaching trailing stop level. My rules tell me to get out of half of the amount of shares that I have. I got out for a 6.75% gain. We continued to go down, and then we had this huge rally up where daily profit targets, daily profit targets, daily profit targets, daily profit targets, daily profit targets. Then we had a few days down. On Thursday, had a daily profit target as well. So this particular trade at the moment with the shares that I have remaining has been a really nice trade, up 14.69%. Now, you can see we are in this red order block now. That's a bearish order block. And when we go over the potential trades, upcoming trades for next week, I'm going to get a little more, I'm going to explain a little bit more about why this is an important level. Honestly, if I was not in this trade, I would have been shorting here on Friday. But I did add a short, but I'll get to that in a minute. But we are getting into a serious level of resistance here after this big move up. We have a bearish order block. We have the 200-day moving average. 2 days in a row, we've rejected it. So, be careful out there. This has been a huge rally, and thankful for this rally for sure. But technically speaking, we are getting into some severe levels here of resistance. So the remaining shares that I have on this QQQ trade that happened from this order block, up 14.69%. Okay, here is Google. You see the green box? Green box means order block. I took this on the 7th of May with the rejection of the high of the order block. I got long 151.47. I position size correctly based upon the volatility and my account size. I placed my emergency stop 2 ATRs below my entry. My end of bar stop is simply a close below the low of the order block at 146.10. I placed my 1.5 ATR trailing stop level above. The next day, bounced up, very nice. Did hit some profit targets, so I took off some shares at a profitable level, reduced my position size, and then on Friday it was down $1.53.99%. So just getting going with this trade, but so far up 0.88%. So we'll see what happens with Google. Merck. Okay, this was the trade, everyone, that I was talking about at the beginning of the podcast, that I was really excited about this trade. I based upon the low price of Merck, based upon the technicals and the order block, I was really quite surprised, actually, what's happened. I'm still in the trade, barely, by a thread, but let's go over it. So you see the green box. This is an order block. Why is it an order block? Okay, we have a low, a swing low, we have a swing high, we have a swing low, and as soon as you have that in place, you look to the left and you see the first swing high. If you take that swing high out, that will change market structure to the upside. And as soon as you change market structure to the upside, you can define your order block. You look, your lowest bar close prior to the change in market structure to the upside, it's the high and low of this bar on 416. And that's what you see here with the green order block. Now, on the 6th, we rejected the top of the order block. And I made the decision when I entered here that I was only going to enter a half a position in case it moved lower. And this big bar down here, that's the reason why I decided when I see big bars, they often can go lower. But I got into half the position at 79.02, and thankfully I did. Okay, the next day we rejected the top of the order block again, and I thought, well, maybe I should have put a full position. Then the next day, this was the key day here, I entered the second half of the position at 77.72. So half of the position here at 79.02, half of the position 77.02, and I picked this particular level here because if you go back over to the 24th, we had this big reversal bar that went down and reversed all the way back up. When you have a big up bar like that, halfway of that bar is going to be some inherent support, and that's exactly where this stopped on the 8th. So to me, I was actually quite confident that because we're in the order block and we rejected halfway of that was probably it, and we would probably start to go back up. So Friday morning, woke up, it had gapped up, it had gone up, and I was like, oh great, this is perfect. But look what happened at the end of the day. It wasn't just Merck, it's all the healthcare stocks, Pfizer and the indexes and so forth, just sold off at the end of the day. Now, the stop on this trade is the end of day stop, the low of the order block is 75.93. We closed at 75.97. So it closed above my end of bar stop, so I continued to take the trade. So this particular trade, well, I half position here, half the position there. We'll just kind of cut it right there in the middle. So net for me, I am down about 3.04% on this trade. And remember, my end of bar stop 75.93 at 75.97. So it did close above, so I'm going to stay bullish on this particular trade because the level held for me. Monday, if it closes below, obviously I have to get out of the trade. So the shares that I have on Merck right now on this particular trade down 3.04%. But if you would have asked me on Thursday, do you think this is going down from here on Thursday's price? Honestly, I would have said, no, I don't think so. We're in a bullish order block. We rejected halfway the big up bar. One other thing too is if you look at the MACD bars here MACD bars, they're momentum bars. You have the red, you have the green, and now you have a little red. So, this is what one of the things that I teach in my one-on-one course is something called bullish MACD divergences. And here you have this low over here with this deep red MACD bars, and then you rally into green MACD bars, and now you pull back, even though we are even now with the lows in the past in April. Do you see how the MACD bars are very shallow? They're not very deep like over here. So what this is showing is that the momentum, even though this looks strongly down from a MACD perspective, the momentum down here, not very deep. The momentum here, very deep. This is a bullish situation. This is showing that you're essentially running out of selling momentum. If you run out of selling momentum, the implication is you're going to be going up. So we have a double bottom bullish MACD divergence. We have a bullish order block. That so far has held, but Monday, if it closes below, I'm going to have, at the close, I'm going to have to get out. However, that does not preclude me from getting back into the trade if it then closes back in the order block. And again, big picture with this double bottom bullish MACD divergence, I'm certainly going to get back in if I get a new signal, if I have to get out. Let's just hope I don't have to get out anyway. This holds, but we'll see what happens. So these particular trade down 3.04%. Okay, ARK. ARK is a trade that I got into on Friday at the close, and I got short. I got short on ARK 51.35. Why? Multiple reasons, really. This is a textbook perfect short trade. Whether it works or not, I don't know, right? But I have a very close end of bar stop, and that's all I can do. I can look for confluences of signals. I can look for a good risk to reward ratio where I'm limited if I'm wrong to the upside, and if I'm right, I have a long way down. Let's look and see what happened here. We have a high here on 428, swing high. We have a swing low, and then we have a swing high. And then here on the 6th of May, we take out that first swing low. What does that do? That puts us into a bearish market structure. We were in a bullish market structure here. Here on the 6th, we went into a bearish market structure. So if I'm in a bearish market, as soon as I change structure to the downside, I can identify my bearish order block. It's just the highest bar close right before market structure change. So the high and the low of this order block is 52.58 and the low is 50.77, and that's the red box here. So on Friday, we rejected the high of the order block, didn't we? That is a legitimate signal by itself. However, in addition to rejecting the high of the order block, we also rejected the 200-day moving average. This is the black line. That is also a bearish signal because during the day we were above the 200, but sellers came in and drove it back above. Now we have the resistance of the 200 above us. If you're short, you want to have resistance above you. If you're long, you want to have support below you. So far, two signals: rejection of the high of the order block, rejection of the 200-day moving average, and in addition to that, we have a bearish V1 signal. If you'd like to learn more about V1s and V2s, go to my YouTube channel. I have a lesson there. They're great entry signals. And in a bearish V1 consists of two bars: bar 1, bar 2. Bar 2 goes above bar 1's high and closes below bar 1's low. And you'd be amazed using V1s and V2s to trigger you into a trade how accurate they can be. They don't always work, obviously. So I got short here, 51.35. My emergency stop, and then I position size. My emergency stop is 2 ATRs above. My end of bar stop is simply a close above this 200-day moving average. It's simply a close above this black line. See how close we are to it anyway? So Monday, if it closes 10 cents above, I'm just out, right? I waited for the signal. I have my lines in the sand. If it closes above the 200, 10 cents, 20 cents, 30 cents, that's fine. I'm just out. I just take the small loss and that's it. However, if I'm right, I have a long way down potentially on this short trade. So it's just risk to reward ratios, line in the sand. My line in the sand is that 200-day moving average at 51.66. Place my 1.5 ATR trailing stop level below. So if I get there, then I go into trailing stop mode. And on top of that, I'm going to take partial profits. Right now, it's 51.35 is the closing price. What's the 0.45 ATR? 84 cents. So 51.35 minus 84, I don't know what that is, but that will be my first profit target to the downside. Then I'll take my first profit target to the downside, minus 84 cents again. That will be my second, and I'll do it one more time to the third. So this is a really good example of a confluence of short signals with a very good risk to reward, that if I'm right, I have the potential for a big gain. If I'm wrong, well, I have a very tight stop. So I can't control the market. You can't control the market. All we can do is construct our trades with good signals, with a confluence of signals and a good risk to reward ratio, and then follow our rules from there. But I like this setup. It doesn't mean it's going to work, but technically it's perfectly a great setup with a very good risk to reward ratio. All right, and I got short essentially right where it is, so even on this trade at the moment. Okay, so those are the 4 open trades that I have on the dailies. The Qs, the remaining shares, up 14.69%. Google up 0.88%. Merck currently down 3.04%. And ARK, the short on ARK, completely break even. Okay, so those are the daily open trades. Let's go to the daily close trades. Okay, here we go. This is WGS. This turned out to be a losing trade, but let's take a look and see why I got in the trade on the first place. Okay, here is the green box. That is an order block. I got long WGS at 66.87. With the rejection of the high of the order block, I placed my emergency stop 2 ATRs below. And if you remember, if I get there, how much have I lost? 1% of my account. But again, 95 or 5, that's only going to happen 5% of the time. The other 95% of the time, I'm going to take a loss with my end of bar stop, which happened here. I had to get out at 57.30. Why? Well, I took the trade because of the rejection of the high of the order block. The next day, it didn't do much, kind of sideways the next day down. And then on the 7th, it closed below the low of the order block. So I just unfortunately had to get out of the trade. I had to follow my rules. It's never fun to follow your rules. It's fun to follow your rules when you make money, but it's not fun to follow your rules when you lose money, right? So down 16.48%. Huge amount down. This is why it's so important that you position size correctly. Because look, the way that I position sized, had I got all the way down here, how much would I have lost of my total account? Okay, I would have lost 1%. But this wasn't even a half of a percent. So yes, this looks horrible, 16.46%, but it's because I position size correctly that I only lost about a half a percent. But I did have to get out with the close below the low of the order block for a loss of 16.4% on the actual trade price. But overall, in my account price, it wasn't even a half a percent. Make sense? All right, so that one was brutal. But you never know which ones are going to work and which ones not. And then MasterCard. Okay, MasterCard was a short position. You see the red order block here. So I'm looking for a bearish position on here. And the reason why, over here we have a high, swing high, followed by a swing low, followed by a swing high, a change in market structure. This defines the order block. The order block goes forward. I did get short MasterCard here on the 1st of May with rejection of the bottom of the order block. I got short 546.56. I position size correctly. I placed my emergency stop 2 ATRs above. My end of bar stop is a close above the order block. This happened here on the 5th of May, and I just had to get out. My rules called for it, and it was a loss of 2.68%. Nothing I can do other than just follow my rules. One trade out of the next 1,000 trades. Overall, in time, I know that I will make the money on these trades. Why? Not on each particular trade, but just because I have an edge over time. Good risk to reward ratios, confluences of signals. When I'm wrong, be wrong small. When I'm right, I have the potential to be right big. So I did exit a loss on the short of the MasterCard trade for 2.68%. So yeah, it was kind of a tough week with Merck and with WGS. Healthcare in general just really got beat up. Just really got beat up, and they all participated in the move down. Okay, so those were all the dailies. So WGS, the close trade, loss of 16.48%, and MasterCard on the short, loss for 2.68. Let's head over to the weekly trades. Everything I've shown you so far were daily trades. Weekly trades, I also like to trade weeklies. Weekly bars close on Friday, so I have to make my buying and selling decisions on Friday. And let's start with weekly trades here on TLT. Okay, so on TLT, I exited, and remember, these are weekly bars. I entered TLT on the 17th of January at 87.20. So I've had this trade quite a long time, actually. What kind of trade was it? Well, again, this was an order block trade. You would think that I only trade order blocks, but I don't. I trade a lot of I actually trade 7 different strategies, but just because of the recent market action, a lot of these order blocks have triggered, and that's why it looks like I only trade order blocks, but I don't. So I entered here on the 17th of January at 87.20. Why? Well, it was simply a rejection of the top of the order block. That's the main signal. 2 contributing signals would be that we also rejected the negative third ATR channel. This is the gray line here. 92% of prices, when they get to this negative third ATR channel, stop going down or start to go up. So when you start to get to this negative third ATR channel level, well, you should probably look for potential signals. So in addition to rejecting the negative third ATR channel and reversing back up, in addition to rejecting the order block and closing back above it, we also had a V1. I just showed you on ARK a bearish V1. Well, this is a bullish V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So that's the signal, right? Get in 87.20. My emergency stop is where? Always 2 ATRs below my entry. My end of bar stop is where? A close below the low of the order block, the green box. I place my trailing stop level 1.5 ATRs above. And then going forward, if we move up the value of 0.45 from the previous bar's close, I take partial profits. The next week, it gapped up higher, closed about the same, no profit targets. The next week, moved up, profit target. The next week, moved up again nicely, took some profits off. The next week, nothing. The next week, nothing. The next week, big move up, hit multiple profit targets. Took those off. The market can't take those away from me, reduce my position size. And in addition, on that week, I got to trailing stop mode, which means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Then we moved sideways for a month, didn't do much. Then we had this big up bar here on the 4th of April where I hit multiple profit targets again. So again, taking profits here, taking profits here, taking profits here. And this is a perfect example of why it's so important to take partial profits when you have them. The next week, we had the big crash down. We had the big dilemma and the worldwide crisis with interest rates, and we moved down. Well, we clearly closed below the previous bar's low after reaching trailing stop level. Took a small loss on half. Remember, I get out of half when I have a close below previous bar's low. Took a loss for 0.59%. The next week recovered a little bit. No profit targets, but recovered. The next week did get a profit target up here at profitable levels. The week after that, we moved up before we reversed back down. And then this week, we were down again. So this trade has really kind of gone nowhere at the moment. The remaining shares down 0.17%. But all in all, am I up on this trade? Absolutely. And why? Because I took partial profits, right, on the way up. So buy and hold with these type of positions, I would be slightly down 0.17%, but because of the taking partial profits when the market gives them to me, still up on the trade. Make sense? All right, so that is TLT. Let's go to Nike. Nike, I did get long Nike back here on the 18th of April. Why? What was the confluence of signals? The confluence of signals were two things. This is a deep dip buy, no order block, just a deep dip buy. Under 30 during the week, close over 30 at the end of the week. That's just a straight up deep dip buy under 30 over. And then I was talking about the negative third ATR channel. This is the thick gray line here. During that week, we also went under the negative third, and more importantly, we closed over the negative third. So that's the confluence of signals. Remember, I don't like to take trades with just one signal. I like the confluence of signals. So I got long here, $55.80. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. And then my end of bar stop, because this is just a straight deep dip buy, is a close below the 30 RSI on a closing basis, on a weekly closing price under 30 RSI. Why? Because that's why I took the trade in the first place, under 30 over 30. Therefore, if it closes below the 30 RSI, that's my exit. And of course I have my 2 ATR stop down here. So the remaining shares that I have on Nike, still up pretty good, 4.3%. Okay, on this deep dip buy right here. And then last but not least, XLV. Well, I had too much healthcare this week. Merck, WGS, and XLV. But, the reason why is because everything's been racing off on this rally. Healthcare has been the weak sector, and so therefore healthcare is the one that are triggering these signals because it's low, right? But this was just a bad week for healthcare and bad week for me along with it. So I got long here XLV on the 25th of April. Nice major confluences of signals. Again, this is such a good setup that failed. So it just goes to show you, no matter how many signals you have, it can fail. What were the signals? Well, here's an order block on the week that I took this, and by the way, I got long 138.03. It went below the order block, closed above the order block. Just that's legitimate signal. We also, the previous week, closed below the 200-week moving average, then we closed back above it. That's another legitimate signal by itself. So two legitimate signals by themselves combined together is why I got into the trade. And then we have a V1, bar 1, bar 2. Bar 2 goes below the bar 1's low, closes above the close of bar 1's close. Perfect signal, 138.03. The next week it did move up for a minute, reversed back, but held the order block as the stop. I placed my 1.5 ATR level above that. And then this week just closed below everything, closed below the 200, closed below the order block. I had to get out of this particular trade for a loss of 3.47%. So what can I do? I can do nothing, right? I just can't do anything. I could just hold in there and hope that it goes back up, but that is not the right way to do things, folks. Just follow your signals. Look, here's another order block below, and we'll go through this when I look at trades for next week, but this order block didn't hold, right? But below there is very interesting order blocks right here, especially because one, we're in an order block, and two, my most perfect the signal that I like the most is when you have a major moving average, a major deep dip by moving average, like the 300-day moving average, which is this orange line here, inside of a new order block. So it's a combination of potential order block trade along with the combination of a deep dip buy signal here. So right here, and like I said, I'll go through this when we're looking at trades for next week, but I will certainly take another crack at it if we get to this level. And by the way, when you're trading a particular market, a particular symbol, XLV, it's kind of human nature to go, oh, okay, you take a trade and then you lose the trade and then you get a new trade. You kind of don't want to take the trade again, especially if it's on the same stock. I don't know why that is, but I know this. I hear people talk about this all the time. You can probably relate to it because it's kind of like, well, I lost on this one. Do I want to add insult to injury? In my experience, if you get stopped out of a trade and then you have a new legitimate entry signal, I always take it because I know the hesitation, and the one that you don't trade is the one that works, right? So this is what I'm looking for, deep dip buy next week here at the 300 along with this new bullish order block. Okay, so that is it on the particular on XLV. So XLV, I had to get out for a loss of 3.7%. So hopefully next week will be better. And you don't always have positive trading weeks. In this last month and a half, I've had some great trades. Man, I just had some massive big trades, shorts, longs, and it doesn't happen every week. So this week was kind of a bummer. It wasn't brutal or anything, but I'm just used to having a lot more winning trades. So that's just how it goes. Right? All right. Let's talk a little bit about trader psychology before we get on to looking for the trades for next week. All right, this is from Julian Komar. I've been following Julian on Twitter, X, for quite a long time. You can follow him at blog Julian Komar. I really like this particular post because I can relate with it. Not so much for me, but with other traders that I know. I know a lot of traders. I talk to them. I pick up on their biases and honestly, their language. And when I saw this, I said, oh, that's a good combination of thoughts. And so I'll talk about this today. But let's see what he says. Trade what's happening, not what you think is gonna happen, by Doug Gregory. Doug Gregory is a very famous trader. Trade what is happening, not what you think is going to happen. And bringing it back to traders that I know, I have some trader friends that speak very definitively about, oh, well, this is going to happen next week, or, oh, this is going down for sure. And I'm like, why do you say that? Do you have a crystal ball that I'm not aware of? Oh, no, because of this, that, and the other. I'm like, yeah, you just don't know. It may do that, but it may do exactly the opposite. And these are people that have been short the market for the last month that are telling me all the reasons why it has to go down, yet it's going up. Had they wished that when they got into their short, they would have had a good risk to reward ratio and just gotten out for a small loss? Absolutely. Now they're stuck. They are so far underwater on these trades, and will the market go down again? Yeah, 100%. But at some point, but when, we don't know. And I try to tell them, listen, you may think this is going to happen. It doesn't mean it's going to happen. They talk about Trump. They talk about politics and about this and about that. And I was like, you know what? I don't want to hear about that. What I want to hear from you are about your levels. If this level doesn't hold, I'm going to do this. If it does hold, I'm going to do this. That's the only thing that matters. I had to give a little tough love last week. I don't want to condone this behavior, and I felt like as a friend, I really needed to say, I was like, look, I don't want to hear about the news. I don't want to hear about politics, about this should happen or that should happen. All I want to hear about is if you're short, stay short under this line. If it closes above, regardless of whether you disagree with it, it closed above. The market is always right. The trader's not right. The market's right. And that's all that matters. So, if you want to get long on something, great. Get long if you have the signal. But don't get long if you don't get the signal. So trade what is happening, not what you think is going to happen. The key word here is think. Doesn't mean it's going to happen. If you want to get short something, wait for a legitimate signal. If you want to get long something, wait for a legitimate signal. But get away from this prediction mode that a lot of traders get into. Let the market show you that your theory was right instead of trying to front run, get in, and then have it not do what you think it was going to do, and then just stay in it and lose money. So like Julian says, trade what's happening, not what you think is going to happen. So thanks, Julian. Anyway, I hope that was helpful for you, and maybe you can relate with that. And if you do relate with that, just, we're not in the fortune telling business. We don't have to predict. We don't have to be psychic. We just have to let the technicals on the charts at major levels show us, oh, okay, now this is happening, instead of predicting that it's happening. All right, so I kind of went off on a rant there, didn't I? All right. Let us talk about potential daily trades for next week. Now, I always mention this. Here I have 10 potential signals for next week. I have 10 potential candidates. Now, theoretically, all 10 of these could trigger on the same day. Does that mean I would take all 10 trades? No, absolutely not. No matter how many signals, legitimate signals happen on one day, I still only take the best trade. And how do I determine that? I determine that in multiple different ways. Which one has the most confluence signals? Which one has the best risk to reward ratio? What is this market doing on a higher time level? Is there some kind of support or confluence on a higher time level than the time level that I'm trading? What is the relative strength of this market compared to the rest of the market? I give it a scorecard. So I go through, I have 10 that trigger. At the end of the day, I go, okay, ABC, that's the best one because I had the multiple confluence signals. It had the best risk to reward ratio. It looked best on a higher time frame, and the relative strength was such that it was better than the rest of the market. So I have to pick a winner every day. And this is what I do in my one-on-one lessons. This is what I teach my students, how to do these scores, how to do this, because the devil's in the details in trading. And it's just also a good idea. Just take the best one of the day, right? So again, if you're interested in doing the one-on-one course with me, it's 15 hours. I teach you all 7 of the different trading approaches. We do a lot of simulation trades. When you're done, you're going to know the rules like the back of your hand. And, I'm a patient trader. And it's very important to me that my students do well when they finish my course, when they finish my class, that they are legitimately good traders. So again, if you're interested, just send me an email. The email is in the link of this YouTube video. In addition to the one-on-one course that I offer, I also have a really good online video course at udemy.com where I teach you step-by-step how to trade the deep dip buy approach. I've sold so many of those around the world, and I think it has like a 4.8 or 4.9 stars out of 5. And that's a great course. It's 9.5 hours of video. By the time you're done with that, you'll know how to trade the deep dip buy approach. And that's a great way to get started. It's less expensive, obviously, than the one-on-one. Not as good as the one-on-one, but it's a really good place to start. So if you're interested, the link's in the description of this YouTube video. Okay, let's start with Adobe here on the dailies. So there are 2 different levels here that I'm looking at. There's a resistance level and there is a support level. Now, which one's closer? The resistance level. So let's start with that. That's with the red. So here is our bearish order block. We have a swing high, followed by a swing low, followed by a swing high, followed by a market structure break. And so when you change market structure to the downside, I look to short any rallies up into the order block. Well, the high of the order block is 404.32. The low of the order block is 392.99. We're not there yet. I would need to reject this order block before I got short. And you can see as we're getting closer to it, there's more and more resistance here. To the downside, we have a bullish order block. We have a low, swing low, followed by a swing high, followed by a swing low, followed by a change in market structure, making this here the bullish order block from 346.68 to 338.65. Again, we're closer to the bearish order block, so I may be looking for a short here. But of course, if we got all the way down here, maybe look for a buy. But right now, I'm looking for a rejection of the low of this order block right here. But I have to keep my mind open. This could go either up or it could go down. Here's the shortable area for me. Here is the buyable area for me as well. Actually, kind of an interesting chart here. If I was selling iron condor option spreads, this would be actually quite good. I would probably sell my calls up here to 404 and sell my puts down here to 337.77. And I don't know if you guys know this. I don't talk about it a lot, but I really do a lot of options trading. I trade all day long intraday using options, credit spreads, and so forth and so on. And I do this mainly with these order blocks during the day. The bullish support to the bottom, the bearish resistance up above here. And these order blocks are invaluable to me regardless of the type of trading that I do, and especially with options as well. So Adobe, really, I'm looking for a rejection first of the low of the order block, potentially next week of 392.99, or if it goes higher, rejection of 404.32. Let's go to Berkshire Hathaway. Okay, now this is another order block kind of situation. Why? Well, we have a swing high, followed by a swing low, followed by a swing high, break structure on the news of Warren Buffett going to retire. That drove the stock down. That changed it to a bearish market structure. So now going forward, if we have a rally back up and a rejection of the order block here is at 542.07, the low is 535.26. So if we rally up, reject the bottom of the bottom or the top of the order block, potential short. However, if we move lower, well, we just got deep dip buy down here at the 200-day moving average. That's the black line here. So we'll just have to wait and see. But if we do go down lower and for some reason reject the 200, yeah, I'd probably potentially get long here. That's a long ways away, or a move up and rejection of the bottom of the order block for a short. DoorDash. Okay, now, this is one of my favorite things. I've mentioned this a couple times already today, but what really my favorite, absolute favorite setup is when you have a combination of a deep dip buy, 200-day moving average black line, and a bullish order block. Well, here's your bullish order block in the green, 107.23. The low is 162.56. And then you have a deep dip buy moving average, the 200-day moving average right in the middle. My favorite. Absolute favorite, because it's two super strong strategies dovetailing together. So next week, if we reject the high of the order block, okay, I could potentially take that trade. If we potentially reject the low of the order block, I could take that trade. But ideally, a move down into the order block with the rejection of the 200-day in the order block would be the perfect spot. And in addition to that, look at the negative third ATR channel. Remember, 92% of prices tend to bounce. Stop going down and bounce. Look, it dovetails right there. It's kissing the 200-day moving average. So 200-day moving average, negative third ATR channel. Inside the order block, this would be perfection. Doesn't mean it would have to work, but it would be a perfection trade, because where would my stop be? When I have a major moving average inside an order block, I don't wait for a close below the order block. I just wait for a close below the 200. So I have a very definitive line in the sand with a very good risk to reward ratio. This is a great potential setup if it gets there. If and only if. So if I looked at this and I said, oh man, in a perfect world, if it came down here next week and rejected the 200, I get into that trade. Here it is. And it still doesn't mean it's going to work. But that's a good setup. So that's what I'm looking for on DoorDash. DIA, which is the Dow. Well, you see the red order block above. Why? Well, we had a swing high, followed by a swing low, followed by a swing high, followed by a break in market structure. So if you break market structure to the downside, I want to look to short any potential rallies back to the order block. So two potentials here. Look, there's the 200-day moving average above you, and then you have a very narrow order block. So going forward, I'm happy to short either a rejection of the 200 above me. Look, the negative or the positive third ATR channel is above. So just the opposite of DoorDash, you have the 200-day and the negative third ATR channel. So next week, if we reject the 200-day moving average, potentially I could get short there. Or if we reject the bottom of the order block, looks like 423.86, or the high of the order block, 427. So essentially, this is the area that I'm looking to short, either the 200, the bottom of the order block, or the top of the order block. But only if it gets there. If it doesn't get there, I'm not going to mess with it. Why? If I think it's going down, well, I don't necessarily think it's going down. But if it does get there, I just know we're coming into resistance, but I have to be able to structure my trade upon level so that if I'm wrong, I could be wrong small. Well, the 200-day moving average in that very narrow bearish order block gives you that opportunity. GDX, gold miners. Two really good setups here. First is the bearish order block. Here's our swing high, swing low, swing high, market structure break. This defines this, this defines this order block going forward. The low of the order block's 51.29, the high of the order block's 51.92. A rejection of the bottom of the order block would be legit, a rejection of the high of the order block would be legit, or a rejection of this red line in the order block would be legit. What's the red line about? Well, back here on the 21st, big down bar. When you have big down bars and you rally to halfway of that big down bar, there's inherent resistance there. So it's kind of like having a 200-day or a 250 or a 300 running in there. It's not, it's halfway, but to me, that is legit. So a rejection of 51.29 would be a legitimate short for me. A rejection of 52, which is halfway of the big down bar, would be a legitimate short for me, or a rejection of 52.81, which would be the high of the order block. Now, conversely, look down here. This is a beautiful bullish order block. And look at that. 200-day moving average resides inside the order block. So, to the downside, a rejection of the high of the order block at 42.55, a rejection low of the order block at 40.26, or a rejection of the 200-day moving average deep dip buy in the order block at 40.30. Goldman Sachs, GS. Okay, well, you see the red above. Must be that I'm looking for a short, and this is an order block up here. So a rejection of the bottom of the order block at 578.45 would be one option. A rejection of the high of the order block, 586.70, or a rejection of the red line would dovetails into a big downward bar to the left at 581. And you can see we're getting close to that order block. The market hasn't wanted to go up more. I mean, look what's happened in the last 6 days. Basically nothing. Just sideways motion as we've moved up into those order block areas. Meta, again, the same. Order blocks, order blocks, order blocks, because everything in this market on this rally is now coming into the order blocks. Here's the order block back here on the 25th of March. Swing high, swing low, swing high. Market structure change. This defines the order block, and it's a narrow one. 621.18 is the low, 633.81 is the high. You can see the last 6 days we've stayed underneath that. So I'm looking for to get short here on Facebook if and only if we reject 621.18 or we reject the high of 633.81. And it's tried to get up there, hasn't been able to do it, but that's what I'm looking for. RBLX, Roblox Corporation. Okay, finally we can talk about something other than an order block. Okay, so let's talk about abandoned babies. Now, if you'd like to learn more about abandoned babies and their cousins, island reversals, go to my YouTube channel. I have a really good video there that explains in detail what these are. These are extremely strong signals, and they have to do with the opening price. So here is a bearish abandoned baby. Why is it a bearish abandoned baby here on the second? Well, on the 4th, we gapped up. So overnight, there was really good news. People were excited. The sentiment was very strong. But then the very next day, it gapped down. So we had very bullish sentiment, immediately followed by very bearish sentiment. So gap up, gap down. This is what makes this a bearish abandoned baby. Now, how do I trade these? Well, actually the last three out of 4 days was a legitimate signal. When it gaps, when you have a gap up followed by a gap down, and then you attempt to go back up and reject the bottom of the baby, and the bottom is 71.20, that is a legitimate signal. And when that happens, it's very simple. On this particular type of trade, I don't do partial profit targets and all this. I just do two ATR stop above and a 4 ATR profit target below. That's it. That's the only strategy that I use this, but it simplifies it very much. Well, I was looking at shorting RBLX on Friday, but you see how it closed above the high? Closed above the low of the abandoned baby. So that's why I didn't get into the trade. So if we close back below that low going forward, I may get short there. And if I do get short there again, 2 ATR stop, 4 ATR profit target. So if I'm right, I'm going to make twice as much as if I'm wrong. And cherry on top for that is that my research on these is about 70% of the time when I'm right, I'm right on these 70% of the time, I'm wrong 30% of the time. But when I'm right 70% of the time, I make twice as much as when I'm wrong. Right? Going back to that casino analogy and having the edge, there's the edge. So on RBLX, I'm looking for a rejection of the low, and the low is 71.20. Let's go to Shopify, SHOP. It seems like deja vu every day when we look at these, but we are in a bearish market structure. So if we're in a bearish market structure, I want to short the order block. The order block, the low is 97.63. The high is $149. So with the rejection of the low or the high of that order block, potentially get short there. And then last but not least is the SPY. Looks like a lot of other charts I've shown you, but this is a major moving average. Major order block from 576.41 is the high, 573.69 is the low. Swing high, swing high, swing low, swing high, market structure change. And this one, look, has that 200-day moving average living right below the order block. So going forward next week, if we reject the 200-day moving average above us and close below, that's a potential short. If we reject the bottom of the order block, that's a potential short there at 573.69, or if we reject the high of the order block, 576.41. Just want to show you, I was just talking to you about RBLX, right? About the gap up followed by the gap down. This is a bearish abandoned baby. See it? Gap up, gap down. Let's look at SPY. Look at the bottom. Gap down, followed by a gap up. That is a bullish abandoned baby. See? Gap down, followed by gap up. Going forward, was it higher? Clearly. That's why on RBLX, when you have a gap up and gap down, the tendency is if you go into the future, it's lower. Make sense? So yeah, SPY looking for rejection of the 200-day moving average, or the low of the order block 573.69, or the high 576.42. And just kind of as an aside, just the market in general. Look, if we have some good news with China, we have some good trade things, we may jump up and close over that 200. There's no doubt about it. It's certainly within the realm of possibilities. But if we don't have that, then this is a major level of resistance, and don't be surprised if we go down. But I'm not predicting, I'm just saying if we do reject that 200-day moving average, then maybe we go down without some kind of trade deal. All right, let's get on to the weeklies, and then we will be done for this week. Let's go to the weeklies on CCJ. Okay. Don't know if this one's going to trigger, but it is completely legitimate. We have formed a bullish order block. Why? Because we had a swing low, followed by a swing high, followed by a swing low. And last week we took out that previous swing high, putting this into a bullish market structure and defining our order block. The order block, the high of the order block is 42.63. The low of the order block is 36.43. And a level inside the order block that I like is this bar here on the 11th, big up bar move. So therefore, halfway of that big up bar more than often gives us some support. So going forward, if we have a pullback, now that we've changed market structure to the upside, I'm looking to buy a pullback with a rejection of the high of the order block, a rejection of the middle of this big up bar here, 38.40, or of course, a rejection of the low. Let's go to Southwest Airlines. All right, there's a wide bearish order block above here. I don't like the wide ones because the wide ones, the risk to reward is greater. And I like to keep my risk to reward where I have a small risk. So to me, a rejection of the 200-week moving average above us at 33.67 would make a lot of sense. One, it's in a bearish order block. Two, it's substantial resistance of the 200-week. So if and only if, on love, next week we continue higher and we reject the 200, that would be my short entry. My stop would be a close above the 200. Tesla. On the weekly. Okay, in the last couple of weeks, we have changed market structure from the downside to the upside on Tesla. Here we have a swing low, here we have a swing high, here we have a lower low. Last couple of weeks, we took out the previous swing high. That changes it into a bullish market structure. What I really am looking forward on Tesla to buy is the combination of the deep dip buy 200-week moving average in the middle of the bullish order block. There's one other level here. The 200 is at 250.30. I also like the level of 254. Wait, did I say that right? Yeah, 250.30 and 254. Yep, right here. So if we do pull back next week, reject the 200 or reject that halfway at 254, for me, that would be an excellent long entry point, and my stop would be a close below the 200. Let's go to Walmart on the weekly. Okay, well, Walmart, look, we went straight down, we've gone straight up, and we're running into a bearish order block. The bearish order block would be a rejection of $173 or the high of 104.76. So rejection of the bottom or the top of the order block. And then last but not least, XLV. I had to get out of this trade on Friday yesterday for a loss. But again, Just because I had a loss on this trade is not going to preclude me from getting into this trade in the future. There's a beautiful combination below on XLV. We have a new bullish order block even further below. And inside of that order block, we have a 300-week moving average. So if I reject the high of the order block at 128.54, I could certainly take the trade there. If I reject the bottom of the order block at 122.63, I could take the trade there and get long. But ideally, what I'm looking for is the price to come into the bullish order block and reject the 300-week moving average, which is at 126.01. That's still $6 below us, and it certainly could get there. Look, healthcare is severely oversold right now. There'll be a time where healthcare comes back into vogue. I'm not predicting, I'm just saying in general that happens, but let's wait and look for a beautiful entry signal. And to me, a rejection of that 300-week moving average inside of the bullish order block would be great. So that's it, everybody. I hope that you found this helpful. If you did, I'd appreciate a thumbs up. I'd love to have you as a student. I'll teach you everything that I know from 30 years of experience in trading. I've turned out some really great traders, and I think the best way to learn anything is one-on-one with your instructor. My course is, it's pretty intense. It's 15 hours or more, so we're going to be spending a lot of time together, but I teach you everything you know. You're going to learn a skill you can use for the rest of your life. And so if you're interested, just let's start the conversation. Just send me an email. The email is in the link of this YouTube video. If you're interested in the online course that I have for deep dip buys, that link, the Udemy link, is also listed there. I really appreciate you spending your time here. And like I said, I hope you got a good return on your investment, and that you learned something today. Listen, if you could go out and try to do one nice thing for another human every day, it would just make the world a better place. If you could go out and try to do one nice thing for an animal each day, that would also improve the world. I was raised with a lot of animals. They appreciate acts of kindness just like we do. So, really appreciate you being here. I hope you have a really good rest of your weekend. Good luck trading next week. Follow your rules. If you have any comments or questions about anything on this podcast, just send me a message and in the comment section, and I'll do my best to get back to you as soon as I can. But thanks again for your time, everyone. And God willing, I'll see you next week. Thanks a lot. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.